Hi, Jeff.
Hey, Meesha.
Welcome to another episode of the North Atlanta Real Estate Podcast with Meesha Rawal.
And Jeff Ahi.
And today we're going to delve right into the FHA loan, the VA loan, and touch upon the loan assumptions of both these loans.
Yeah, that sounds like a great program.
Yeah. And do you want to talk to us about the FHA loan and who qualifies, what would be the area that you qualify in, and
Sure.
all the good things?
Absolutely. Okay, so FHA loan. So what that is, it's insured by the Federal Housing Authority. So that's a government entity. All folks are eligible for this. And so there's no other requirements. Some of the benefits and maybe some of the reasons that somebody would want to get an FHA loan, one, they have a little bit more forgiving qualifications on the credit scores and also on the total payment debt to income ratio you have for your house and your other debts. So you might be able to qualify for a little more house by doing that. And especially if you have a low credit score, it goes down to you can still put 3.5% as your down payment. That's the minimum amount with an FHA loan. And you can do that down to a credit score of 580. And you wouldn't be able to get a conventional loan with a credit score down in that range. So for borrowers with bad credit, definitely a good option. Couple of other things to keep in mind with the FHA loan. The way that the mortgage insurance is handled, you pay 3.5% as your down payment. Then to do the mortgage insurance, you have a 1.75% that has to be paid at the time you close the loan. And that can be financed in. You don't have to come out of pocket with that amount. So that's financed into your loan. And then you have a monthly fee that is 0.55% per year of your total loan amount, then divided by 12 to get your monthly mortgage insurance premium. So one of the other nice things about the FHA as well with the VA is that the interest rates are about 0.5% lower than what we find with the conventional loans, I believe, right?
FHA does not stand for a first-time home buyer.
That's correct.
Okay. So it is not just for first-time home buyers.
That's correct. It's just any home buyer qualifies.
Okay.
Yeah.
And what if I have a bankruptcy in the past 5 years, 7 years? Do I get some sort of leeway?
Yeah, and I believe if you've had a bankruptcy even as recent as 3 years ago, that still is going to be acceptable to FHA. So there is more leniency in that area as well. So that's probably, if you had a bankruptcy in the near past, that's going to be your path back into getting into a house.
Which is probably one of the reasons why my credit score would be low, is I had a bankruptcy in the past.
Yeah, quite possibly, right?
Just helps you get you back on your feet
Absolutely.
with a lower credit score, a lower down payment, and the house qualifies.
Yeah, and so, a lot of, we had, I think, some difficulty back in 2021 and 2022 when the market was moving so fast. There were a lot of agents that kind of looked down upon an FHA loan, especially if you have someone putting a 20% down payment or something, right? It's hard to dislodge from the agent's mind who's advising the seller that is a good option. But the reality is now that our market especially is slowing down, I think you're going to find much more acceptable just financing with these loans, because honestly, if someone is qualified for the loan, it's not that difficult. The requirements of the house itself, like you mentioned, they're not that stringent. I mean, you got to have a stove in there. The carpet has to be installed. The house has to be actually complete and in decent shape, but it doesn't have to be perfect. And so there's no reason to fear an FHA loan in a house. Maybe the only thing to keep a mind, though, is if you have a septic tank, for instance. So if we're talking about our folks, especially up here in maybe Forsyth County, where there's a lot of septic systems, at least there were a while back. If you have a septic system and the house has the ability to be connected to public sewer, they will make you connected, and you can have some difficulties there. But that's really probably the only one that will get people, I would say.
Yeah. And back in Augusta, when I was selling houses, FHA programs for houses, the best way for a lot of people was to qualify for an FHA and then take a little loan to update the house, because not all houses were updated and not everybody had money to, move into a house after putting the down payment. So they would take a sort of a loan to update the house.
Well, there's that. Yes, there's actually a special type of FHA loan. I think it's a 203K, and it's a renovation loan. And so what they do is you can renovate a bathroom, a kitchen, change the roof, do all these things under this program. It does have a little bit higher interest rate when you're doing that, but it's a pretty streamlined process. The only thing to keep in mind there, the home will have to appraise at the new higher amount with the renovations included. So they have some guidelines on how much all these they'll look and see all the new things you're going to do, how much value that'll add to the house. And ultimately, the appraiser's taking that into account when they're doing the appraisal. And so the whole thing will have to appraise for that. But that is a great way maybe to get into a house that needs a lot of work and you don't have the money to do it, but you could use this FHA renovation loan.
Yeah, and I think the loan amount is about the maximum of $30,000, or right about.
Yeah, I believe with one of the programs, it might be higher than that, I think.
Oh, okay.
Yeah.
Okay.
And
I think that was for maybe the VA loan, where it was a little higher. But yeah, and then which brings us to the VA loan, which is another amazing program that we have for veterans.
So why don't you tell us a little bit about that VA loan?
Yeah, so the VA is it's reserved for eligible veterans.
Okay.
Currently active duty service members and qualifying National Guard or Reserve members, and some surviving spouses as well. Mm-hmm. And there is absolutely no limit to the size of the house you could buy with a VA loan. However, there are some lender limits based on your income and qualifications. Mm-hmm. And it's a great program for, because you put no money down. Right? It's 100% financed, unlike the FHA where you put 3.5% down. This, you put no money down. And if you can, in your contract, ask for the seller to pay the closing costs, you essentially have no closing costs. Now, the only fee that you may have to pay is the VA funding fee, which could vary from 1.25% all the way up to about 3.3%, depending on how much money you're putting down. Right? Yeah, if you're putting down nothing, then I think it's 2.15, and if you have a down payment up to about 10%, then it's 1.25%. So
and I think the nice thing with that one, though, there's no monthly fee after that, right? Mm-hmm. It's just a one-time.
Well, exactly, unlike the FHA where we have the private mortgage insurance.
Yeah, the mortgage insurance premium, right? The MIP is about just 0.55, just over 0.5%. So if you had a $500,000 loan, you'd be talking about $600 basically, or excuse me, $2,500 that you're going to have broken up into your 12 monthly payments, about a little over $200 a month.
Okay, so that will go on for the life of the FHA loan. That goes on the life
of the FHA loan. With the VA, you don't have that at all.
Perfect. So if you qualify for both the VA, if you're a veteran that qualifies for a VA and you qualify for an FHA, it may make more sense to go for a VA loan.
Oh, absolutely, I would say.
Yeah. And now you can apply for, you don't have to apply for a VA loan just once.
Yeah, that's correct. As long as you have your eligibility, you can buy another house with it. When you sell your house, the amount of your eligibility then is returned to you effectively, and then you can buy another house. Absolutely.
Yeah, and let's say we're talking about loan assumptions for both these amazing loans, the VA and the FHA loan. If I decide as a veteran that I would like to sell my house, and I had my mortgage interest at 2.5%, could I sell it to someone? Can I sell my interest to someone?
So let's talk about loan assumptions a little bit. Both the FHA and VA have this feature that they are assumable. You have to qualify so that the new buyer that comes in has to be able to go through the same underwriting criteria as the original loan. The two differences between the assumable for the FHA and VA is that, let's talk about, since we're talking about the VA folks, if the seller is having his loan assumed, the new buyer takes over his terms. If that new buyer is not a veteran, then the seller who had that benefit loses that portion of his benefit until that house is resold and that loan is either refinanced or it's resold. Then your veteran might lose that portion of his benefits. He might not be able to buy another house. So he has to keep that in mind. Now, if he sells it to another veteran, then it's no problem. the new veteran will just use his eligibility, and the other guy, the seller, then gets it back. And an FHA loan, since there is no qualification about being in the services and anybody qualifies in that case, anybody can qualify for this FHA assumable. And so just so folks understand what this means, like you mentioned, if somebody purchased by VA or FHA back in, say, 2021 and 2022, when we had these rates at 3% and less, a buyer today could assume the balance of that loan, and their rate is their payment is going to be based on that initial rate. So that is a huge benefit, of course, if you can find one of these loan assumptions.
Okay, so let's run a scenario. Let's say I find a house as a veteran for $500,000. And someone bought that house in 2021 at 3%. And they have paid down systematically, and their loan balance is now $425,000. What do I have to do to assume the loan?
Yeah, so when you're assuming the loan, what you really have to pay as the buyer, you're going to pay the difference between what the loan balance is, the payoff for it, what that is, and what the sales price that is agreed to on the home. So let's say, like you said, $425,000 is your loan amount that you're going to try to assume, but the home, you might have paid $500 to start with, but homes have gone up in value. So now that home, let's say, is worth $725,000. Well, the difference between $725,000 and $425,000 is $300,000. In this case, the buyer's going to have to come up with $300,000 to assume that loan. It can be done in one of two ways. Obviously, if you have the cash, you can just pay the cash. If you don't have the cash, you might be able to get some secondary financing for a large portion of that amount. So even if you had to get some secondary financing, you're still going to find that the blend is probably going to save you money. Now, it depends on how big the spreads are, and you have to do some calculations there with the actual numbers. But I would definitely be looking at that loan assumption if you can run across one. Another thing to keep in mind, closing costs are much reduced if you are assuming a loan. You don't have to pay intangibles tax, transfer, or the intangibles tax is one of the main things you save. You also don't have to do an appraisal again and all these things. And so instead of having 2.5% for your closing costs, it might be 1%. So you save some money there also.
Excellent advice, Jeff. Thank you so much for sharing your insights about the FHA, VA, and the loan assumption. And if anyone has any questions about either of these two loans, please feel free to reach out to Jeff or me.
Yeah, absolutely. We'd be happy to help folks out understand this if we missed a few things along the way. Yeah.
Yes, absolutely. Thank you so much, Jeff.
Yeah, thanks, Meesha.